Chapter 35 Diversification. Stocks are inherently volatile, and you can lose your investments when you put all your eggs in one basket. By establishing, underlying, and following diversification principles, you will ensure long-term success in your retirement planning, savings goal investments, and 9 to noon trading. Stocks may swing up or down 50% in a year. You can minimize your portfolio's volatility and improve overall performance by investing in a wide range of companies in a variety of industries. You do not want your whole portfolio reliant on 3 stocks in the unfortunate event 2 of them tank in a year. The best path to long-term diversification is to limit your exposure to any single investment. Do not let any single stock take up over 5 to 7% of your portfolio. By using this rule, you can ensure that single portions do not determine the success of your overall portfolio. Single positions. You can never be 100% sure on any stock pick, so your whole portfolio should determine your success rather than a few stocks. With a wider range of assets, you give yourself many more chances to succeed while you slowly weed out underperforming investments. Give your losing stocks time to play out if they have a strong underlying setup, business plan, etc., before you cut them from your portfolio. Simultaneously, let your winners run until you think they have no steam left. Remember that the risk with any investment is that the company goes bankrupt and the stock goes to $0. Companies with long histories might be less likely to go bankrupt, but you still do not want to let one stock take too much of your portfolio. By diversifying, you minimize the impact individual downtrends will have on your portfolio. Funds stand out as one great exception to the 5 to 7% rule. Since ETFs and mutual funds already invest in a wide range of assets, all you have to do is consider how they balance their investments. Does the fund simply follow an index, diversifying it across the entire market? Perhaps it focuses on a specific sector. Does the fund invest in high-yield corporate bonds or treasury bills? Perhaps they dabble in foreign equity assets through individual investments or market tracking indices. Nonetheless, these funds are already inherently diversified, so you may need to worry significantly less about diversification with these other options. Take the Invesco PowerShares QQQ ETF, for example. This fund aims to mimic the NASDAQ 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market based on market capitalization. Since it has around 100 stocks, the ETF is already fairly diverse. By balancing a few funds in other market sectors with the technology-heavy QQQ, you can easily create a diversified portfolio suitable for reliable long-term growth. However, this fund alone may not give you ample diversification, especially in downtrends, because it focuses heavily in leisure spending companies and holds particularly high individual weightings. For example, Invesco gives Apple Inc. a 12.44% weight, Amazon Inc. an 11.15% weight, and Microsoft Corporation a 10.01% weight in the fund as of September 30th, 2018. Still, this leaves dozens and dozens of other companies, diluting the volatility of these stocks with their own strong collective performances, even though many are individually weighed under 1% of the ETF. Most ETFs and mutual funds are, by definition, well diversified. The biggest risk you'll see with these are market sector dependence. You could counteract this sector dependence with a more stable, historically performing industry such as energy or industrial stocks, depending on current market sentiment and macroeconomic trends. On Yahoo Finance, you can hover over the Industries tab to get a condensed list of 9 major global industries, or click on the tab to get Yahoo Finance's full list of 215 industries ranging from auto parts stores to cement as of 2018. By spreading your investments across different non-correlated markets, you can significantly increase your long-term diversification to mitigate short-term volatility. These new markets also open up opportunities for technical analysis to find strong potential stock picks. You do not want your entire portfolio to go down because you are in technology or energy stocks exclusively. Let's look at an elementary example to showcase the importance of having many market sectors captured in your overall portfolio. Then we see the portfolio with umbrellas and sunscreen, and then one where you invest in half of each, and it minimizes the overall volatility with long-term consistent growth. If you invest entirely in a company that sells sunscreen, you'll see strong growth during the sunny parts of the year, but poor performance when it rains. The reverse would occur if you placed all your assets in the umbrella company. By balancing your investments between industries, you can achieve consistently reliable returns. The same methodology holds true in real-world industries, although correlation is slightly tougher to calculate. Everyone needs to basic materials and utilities, but services and consumer goods might slump when markets run into trouble and spending decreases, especially luxury good companies. Spending includes credit. To see if two or more stocks or funds you are considering strongly correlate, try comparing them in Yahoo Finance. Simply full screen a chart and press comparison. Here is an example with Visa Inc., MasterCard Incorporated, and American Express Company. And then we see from highest to lowest final return, MasterCard Incorporated, Visa Inc., and American Express Company. So Visa and MasterCard performed very, very similarly, whereas American Express performed relatively poorly compared to the two in the given time frame. Although MA finishes slightly above V, the two stocks have performed almost identically over the past decade or so, while AXP severely underperformed the duo. Therefore, we may choose to invest more of our credit card sector fund in Visa since they currently pay a 0.75% dividend compared to MasterCard's 0.5% dividend. Although American Express currently pays a 1.48% dividend, its poor historical performance makes it seemingly worse investment than V and MA in upward markets. Notice, however, that all three credit card companies follow the same general trend with high correlation. American Express just rises less historically. The same principles should hold true for other companies in this market sector, such as Chase Bank or Discover Financial Services. Therefore, we can diversify our overall portfolio with other market sectors and other stocks perhaps less reliant in the banking and financial sector. The point of diversification is to protect you from rampant volatility in sector-heavy asset markets. By diversifying your portfolio, you can ensure consistent returns while all aspects of the market boom. However, remember that market sectors still perform and recover when overall indices do well. If you have smart sector dependence, you'll be fine with long-term picks that provide growing value because sectors historically move together, as shown below with the American-only, equally balanced, and yearly rebalanced mid to large cap sector indices. Terminology from Chapter 16. Then we see energy, materials, consumer discretionary, consumer staples, healthcare, financials, technology, telecom, and utilities industries. And in the long term, they all go up together. But we can see the volatility is different for each of them, and their respective returns differ. So for some like consumer staples, it has a very high percent return with a very low relative volatility. So that would show strong potential long-term investment if you look at returns by economic sector from 1963 to 2014 in these given industries. Point being that everything goes, and it goes well, with an emphasis on consumer staples. From highest to lowest final return, we see consumer staples, healthcare, energy, materials, financials, industrials, consumer discretionary, technology, telecom, and utilities. And these would be, not individual stocks, but like the entire market sector and the overarching growth of that industry area. So, although one sector may boom while another one busts, the overall market increases together in the long term. In this example, notice that the consumer staples offered the highest historical sector return with the second lowest volatility. Not bad. When you start out small, you might not be able to fully diversify due to your account size or commission costs. You might even have to avoid larger stocks until you start depositing into and growing your account unless you're buying funds that are already diversified. It is tough to balance a $5,000 portfolio on Amazon.com Inc. when it costs upwards of $2,000 at its 2018 highs, but significantly easier to enter the market buying computer gaming peripheral company Razer Inc. for 15 cents. The great thing about stocks of all sectors and sizes is that you can buy as many shares as you want to achieve your desired position size as long as the price for one share fits in your portfolio. By working towards strong diversification, you will ensure long-term success no matter short-term market conditions. As you near retirement and savings goals, reference the following recommended bond allocation tables. These are simply suggestions, and you may choose to raise or lower your exposure to bonds versus equities depending on overall market conditions. If you see a strong economy brewing, perhaps wait to invest in bonds until interest rates follow. Similarly, you may invest more in bonds during a high point in the overall market. Then we see non-bond allocation versus years of retirement, and it consistently decreases across a given spectrum of risk tolerance levels, starting all the way from 0 or about 20% at retirement to 100% in an aggressive growth fund, being in non-bond allocations. Then under that we see non-bond allocation versus years to savings goal, and it's a little bit of a faster decline at the end rather than that gradual years to retirement flow chart. So as we get towards that retirement goal, it's just going to decrease a lot faster. From highest to lowest final non-bond allocations, we see aggressive growth, aggressive, moderate, betterment, conservative, and ultra conservative. So non-bond, that would just be like equities, indices, stocks, any other forms of investments outside of fixed income. Many recommend these bond trends near retirement and savings goals because of the following well-documented tendencies and inherent volatility in the stock market. The dots in the center of each volatility bar represent the average excess stock market return over average high-grade corporate bond index returns. And then we see the annualized excess stock return versus the return of nominal bonds. And the range of excess returns is the volatility of the stock market shown in relation to the bond return, and the average excess return over the long term for the given look-back period is shown as well in the lighter color. So if you look at the 1 year chart, it's significantly more volatile, going up 50%, down 40+%, and then on the 3 year it goes down, 30% up, 30% down, and it keeps becoming more and more controlled until once you get to like a 20 year or 30 year look forward period, you're essentially looking only at long-term gains with an annualized return of approximately 10%, beating average bonds significantly. Notice that in the long term, stock returns historically prove superior. This data extends from 1926 to 2014, covering all recent stock market crashes, panics, downturns, and more. Regardless, stocks still average out to grow your wealth through uncommon returns. As you diversify your portfolio, always remember correlation. The more uncorrelated your stock picks, the better your portfolio diversification becomes. Fund manager Ray Dalio's Holy Grail chart shown below shows this principle well. And then we see the annual portfolio standard deviation of any given portfolio from 1 to 10%, and that in relation to the number of assets and alphas in the portfolio. And then there's a couple different, 5 different lines, and those are different levels of correlation. So the risk to return ratio and the probability of losing money in a given year, the probability of losing money decreases as you have less correlation, and the risk to return increases as you get more return for your unit of risk. On the left side of the chart, we see the risk of any individual investment based on its return. The asset could go up to 10%, down 10%, or more in either direction in periods extending past single standard deviation yearly movements. The standard deviation simply measures inherent asset volatility. As you add more assets with similar risks and returns, the trend lines show you how your return to risk changes based on the correlation of your underlying positions. At a certain point, your risk reduction depends on the correlation of the underlying asset more so than the number of diversifying investments. At 7 or 8 assets, you decrease the risk of losing money in a given year from 40% individually to 11% with perfectly uncorrelated returns, like in our umbrella sunscreen example. As you focus more on correlated market sectors, you may expose yourself to more correlation risk, but you can simultaneously push for higher returns through active management. Estimate your potential profits versus stop loss maximum risks to work towards improving your performance, your profitability through technical analysis. Alternatively, decrease long-term risk through global diversification and alternative investments, which we'll explore soon. With 15 or 20 solid, uncorrelated return streams, you can minimize your total risk while maximizing steady returns. Following the 5 to 7% rule, you will never lose your 10% return, but you may reduce your risk through other investments that you cannot predict the performance of. Your overall portfolio will continue to grow over time, but individual growth is blended into the performance of all your other positions to minimize volatility. With 5 times less portfolio deviation, you can quintuple your risk to return ratio in any one portfolio. You can use this mindset to minimize your investment risks through the holy grail while still fighting for market-beating returns through technical analysis and individual equities. Always consider how much time you have to be aggressive in the market, understanding that it is okay to take on more risk and higher returns when you have a long time ahead to recapture losses while winners run. Nonetheless, you can avoid large portfolio losses with investments in broad, uncorrelated markets shown below. And then we see a really wide group of investments ranging from inflation, U.S. indices, large caps, mid caps, small caps, U.S. funds, U.S. real estate, consumer staples, industries like healthcare and energy. Then there's total international funds, intercontinental funds, exchange funds, global real estate funds, emerging market funds, frontier funds, tons and tons of funds, gold, lots of individual countries and their large returns, especially given the following chart that we're going to look at that'll show individual country returns. And then there's like emerging markets, internationals. These are bonds, corporate bonds, U.S. bonds, and then sort of more just tips, muni bonds, municipal bonds, long-term treasuries, and more treasuries, treasury bills. And then you can see that the more, and those are on the top and on the left. So you'll have them compared to each other for their correlation to one another in the long term. So the more correlated they are, it's going to have higher value, which means more red. Correlation, bad for diversification. Then the less correlated they are, it means they're going to have a lower value compared to one another. They're going to be a little bit more green. So darker would be more correlated, lighter is less correlated. Red values indicate high correlations, whereas green values indicate a low correlation, each item's respective counterpart. Notice that essentially all U.S. equities are closely correlated, and these assets follow major U.S. market indices. Notwithstanding, these assets provide extremely strong long-term gains as long as you can weather out market downturns. Remember the dollar cost average principle that sits at the basis of value investing when low stock prices tumble. As you gradually purchase assets, you can average your fill prices down the line. For example, you could buy $200 of stock every year, or perhaps invest $150 into a certain fund every month. If the price of the asset decreases, you can gradually purchase more with the same amount of cash as you expect the price to increase in the long term. If the price increases, you can then add capital to your position knowing that you're adding to your long-term growth potential on top of current gains. This methodology is splendid for long-term, low-management investors who want to ensure consistent, fair prices. You can further improve your price fill quality by employing technical analysis to find great buying and selling opportunities in the market. REITs are real estate investment trusts. You can use these to take advantage of real estate returns without the active management needed to collect rent every month. These trusts often yield high dividends and percent return, compelling long-term opportunities in good housing markets. There are unheard of value opportunities in long-term American equity asset markets to take advantage of the prolific and regenerative U.S. economy. The U.S. stock market makes up over half of the entire world's publicly traded stock market. With that said, some investors turn to foreign equity markets for risk management because most global economies are not immediately correlated, as shown above. Some investors turn to emerging foreign markets in search of extremely high returns in its new economies. Boo! The following scatter plot reports average GDP growth and stock returns over the long run from 1900 to 2009 in global market indices. Although you may outperform the market through specific stock picks, most global indices underperform the American markets even when they have rapid emerging economic growth. Remember that most stocks' prices depend on its underlying public perception. Just because a stock is expensive does not mean it has a large market capitalization or vice versa. Look for corporate value, not just cheap or expensive stock price. In our example with Singapore-based company Razer Inc. earlier, RAZFF shares cost a nickel and a dime, but the underlying company is worth $1,333,000,000, 2018. Rather, pay attention to historical price trends to predict where future market performance might move. Keep in mind that the following international data is from the most recent 2009 bottom in the U.S. stock market. And then we see our geometric real stock returns versus real growth rates in GDP per capita over the long term for a couple of different countries. So we see our range for stock returns from 2 to 9%. Some of our highest returning positions being Sweden, Australia, South Africa, and Canada for this given time period. At the same time, if we look at real rates in GDP growth, Sweden and Japan are sort of the greatest ones, where the US and the UK are a little bit less growth rate in Japan, but still a very, very strong real stock return. And at the same time, there's a little bit of a declining trend line in this, fairly scattered data as increasing growth rates in GDP decrease real stock returns geometrically. And then underneath the US and the UK, we have the Netherlands, Switzerland, Denmark, Germany, Spain, France, Ireland, Italy, and Belgium, as those had historically lower geometric real stock returns, even though some of them actually had higher real growth rates in GDP per capita, as a percentage-wise from 1 to 3%. So, emerging markets might not be the highest growth candidates for you, but international diversification is still very popular. 4 of the countries above seemingly outperformed America, after all. Although it costs more time and money to spread your eggs into many baskets, you can benefit from long-term diversification in international markets through ETFs tracking foreign index funds alongside individual stocks and bonds. Additionally, you can time emerging market stocks to take advantage of superb growth as part of your international portfolio, no matter how long you invest in foreign markets. Just remember, important socio-political factors can affect global equity performance and bond payments. As long as you do not try to time market indices, there are strong international profits to complement your domestic holdings in bull and bear markets. Here's an updated 1900 to 2016 comparison of global market returns post-inflation. Remember that inflation in these markets includes foreign currency valuation changes unless shareholders trade the underlying stock through American markets or perhaps a derivative or share subclass traded over the counter or on the pink sheets. You may see some of these cheap stocks in new trading. For long-term investors, it is fine to invest in reputable companies listed on these less-than-par exchanges as long as you know the value and performance history of a stock you buy. With that said, these stocks historically repel investors because of low listing requirements and often low trading volume on the pink sheets. Look for good liquidity before taking a trade for any time span in these markets. Then we see real inflation-adjusted equity returns around the world from 1900 to 2016, and this list is sorted by its risk-adjusted return from highest to lowest. So Australia and South Africa had higher risk-adjusted returns than the United States, even though the U.S. had higher returns than Australia and a lower standard deviation than South Africa. Still, very, very cool to see with international diversification. This risk-adjusted indexing and sorting is going to help you look for long-term diversification as you look for more value per unit of risk you put out. Even if you get lower returns in, say, the Canadian market, New Zealand market, Sweden market, where those are all, 7-8%, versus the U.S. is 8.5-ish. And if you look at the whole world, that's around a 6.5% average arithmetic mean, given the time frame, with a pretty normal standard deviation. But if you look at risk-adjusted returns, you can have higher percent returns by investing in some of the top 5 countries, while avoiding others that had poor returns, such as Australia, Italy, Belgium, Portugal, France. Some more at the bottom that had higher standard deviations and sometimes equal returns, but generally lower returns. You can make strong returns in foreign markets as long as you focus on long-term thinking and ideologies. Analyze global indices and invest in areas you see high return potentials with minimal risk. If you ignore short-term market movements and invest in strong foreign companies, you are sure to find high-yielding investment opportunities. But please, for all that is good, do not buy the FTSE. The FTSE, or Financial Times Stock Exchange 100 Index, is the index of the largest 100 market cap companies in the London Stock Exchange. Here's the FTSE's performance, lower final percent performance, relative to the S&P 500, higher final performance. And then we see the FTSE and the S&P, and the S&P is very much correlated to the FTSE, but it's got higher overall long-term returns. So even though you're sort of looking at the same risk, you're getting a higher return. Index to index, the European markets tip historically underperform American markets. Here's a Fidelity infographic showcasing 4 differently diversified portfolios. The calculated performance is based on domestic indices, foreign indices, bond indices, and treasury bill interest rates from 1926 to 2015, assuming reinvested dividends and coupon payments. Then we see the conservative, balanced growth, and aggressive growth portfolios based on U.S. stock, foreign stock, bond, and short-term investments. So a fairly simplified portfolio management strategy. And as you change, the amount of short-term investments, the amount of bonds from 50% bonds, 40% bonds, 25% bonds to 25% bonds at the end with more foreign stock, then you're just changing your aggressive growth strategies so that your average annual return will increase and your best 12-month return will increase and your worst 12-month return will increase and your best 20-year return will increase and your worst 20-year return will kind of go iffy-washy depending on how aggressive you go, increasing given your risk in the marketplace, time span in the marketplace, and ability to, conquer and live with losses in the marketplace in the short term. Though you may need especially less diversification in your early investing years, these portfolio balances represent general market diversification sentiment. Fidelity in particular often emphasizes bond fund holdings. For color reference, the growth portfolio has a 5% stake in short-term investments, 21% in foreign stock, 25% in bonds, and 49% in U.S. stock. So again, if you look at those charts, you're really just increasing your holdings in U.S. stock or foreign stock and decreasing your holding in short-term investments in bonds as you get more aggressive. And then as you look at historic performance of foreign equities and indices, you can determine if it makes more sense to allocate more in certain industries or indices or markets, just depending on how the current market conditions look and how current growth prospects are given, news media, but primarily technical analysis and individual foresight. Consider whether or not a portfolio balanced away from new stocks works best for you, especially considering your age. With a longer time horizon, you can weather out market crashes and take advantage of historically higher equity asset growth. Furthermore, we can see that diversified portfolios provide safe havens in economic downturns in exchange for their lower long-term returns. Try to find a balance between safety and growth, perhaps a dynamically changing balance depending on macroeconomic conditions. Just remember that it is much easier to time individual stocks than market indices. Then we see diversification help limit losses and capture gains throughout the financial crisis. So if you were going to retire in 2008, you'd want to be a little more diversified. As we see from 2008 through the market bottom, February 2009, an all-cash portfolio returned 1.6%, diversified portfolio lost 35%, and all-stock portfolio lost about 50%. Then, from 5 years from the bottom, from March 2009 to February 2014, an all-cash portfolio returned 0.3%. A diversified portfolio returned 100%, and an all-stock portfolio returned about 162%. Then, if you look at 2008 to 5 years from the bottom, so January 2008, February 2014, you're going to see an all-cash portfolio at 2%, diversified portfolio at 30%, and an all-stock portfolio at 31%, 32%. So that would be maybe if you didn't time it correctly, say you weren't on your game with technical analysis, which we'll get into soon, and you couldn't identify that perfect bottom to get in at. Before we move on to diversification in 9 to noon trading, please write 5 to 7% down in the blank space provided, preferably with pen. I promise you guys, you can write in this book, should write in this book, take notes in this book, find things that stand out to you in this book, write 5 to 7% down so that you remember it. Use this percent allocation for long-term, low-management, diversified portfolios to prevent any one company or factor from influencing your portfolio too much. As your investing experience grows, you may decide to change these numbers as you see fit to build your opportune, diversified portfolio. It is okay to take higher risks in companies you believe in when you understand the potential downside in even the most certain stocks. This knowledge simply comes with experience. However, remember that any position can go south no matter how great it looks if public perception drastically changes. Diversified portfolios are the basis for building retirements, college plans, and long-term savings goal funds. Continue writing down other principles you learned through trading, as these will help you develop your overall trading strategy and improve your market returns. If 5 or 20 out of 100 companies perform extraordinarily poorly in the long term, you can still prove extremely profitable through diversification. Just do not put everything you have in your Enron employee stock purchase plan. In the short term, expect temporary losses, as it is always difficult to time the exact top or bottom of any movement. As you enter 9 to noon trading, diversification lines fade because you actively adapt to market risk and set precise stop losses to limit your risk while you work towards market-beating returns. Your position size, given enough liquidity, is essentially what determines your trading income once you master 9 to noon trading. Consistent, high, average profits are key to 9 to noon success. As long as you can make more than you lose, you will prove successful with repetitive trades. One example trading setup can exceed your weekly profit goals. The key is taking responsible positions with excellent setups rather than taking as many trades as possible. You do not need to be perfect, but you should understand your trading and work towards better future consistency, profit-loss ratios, and trade success percentages. Let's look at the profit trifecta. Then we see the profit trifecta. We've got consistency at the top, ranging from 0 weeks of consistent gains to 6+ weeks. A trade win percentage ranging from 50% to 70%. And your PL ratio ranging from -1 to 1 all the way up to 2 to 1 plus. So your profit in that scenario would be like $2 for a loss being at $1 or better. And then if you were, average, you'd have like $2 for every dollar you lose. Then your win percentage can help you increase the amount of money you make, even though your profit-loss ratio will be the same. Because if you win more trades, and say you make $1.75 average, and you lose $1 on average, but you win 65% of your trades, and you've been consistent for 3 to 4 weeks, then you're going to be doing very well. As you practice trading, you can work to improve your skills and move towards the center of the profit trifecta to find consistent profit, high success rates, and a strong profit-loss ratio. You never have to be perfect with trading, but you can work towards consistent, disciplined trades to grow closer to the center of the trifecta. It might make sense for you to have a temporarily lower win percentage if you take many trades because of your underlying trading strategy. This is fine as long as you consistently take high-quality setups with good risk-reward ratios and diversification principles. Your trading will significantly improve with patience. For 9 to noon trading, your main goal is to pay as little market tuition as possible while learning to become a consistent, profitable trader. There are loose diversification standards because you will learn over time how much to put into a position depending on how confident you feel about a stock based on your technical analysis and underlying trade momentum. Set aside a certain amount of money for active trading. Then calculate how much you want your average order size to be worth. Generally, try to start off risking lower proportions of your 9 to noon fund and work your way up to your own reasonably sized positions over time as you discover how to manage risk with strong market returns. Here's an example of what happens to a $2,000 trading account when you double your money 4 times, but the market fools you into one bad trade and you lose half your portfolio. Then we see the account value goes up. Very great geometric increase at the beginning all the way up to above $15,000, but then you lose half of it and you're right about $8,000. By risking all of your cash, you present significant growth opportunities, but you also expose yourself to rapid downtrends. As you start trading, learn your principles with smaller trades and work your way up to consistent profitability. Perhaps risking 1/4 of your day trading fund in the example above will help you find consistent growth and leave you less stressed when you inevitably lose trade. Nonetheless, risk what you are willing to lose and always close out your 9 to noon positions by the end of the day, as aftermarket movement in such stocks can be irrevocably unpredictable. Sticking to stop losses also helps limit your losses and psychological burden because you pass off the responsibility of exiting potentially bad trades to a computer. Once you find consistent profits with strong risk-to-reward ratios, you can start to expose yourself to higher upside and losses with larger cash positions. The technical skills you build while learning to allow you to measure your performance through percent gains that reveal your potential profits and losses. You trade for the upside, but you have to be prepared for the downside and analyze exactly how much you risk on average. To streamline your order entries, consider using a handheld calculator to quickly divide your intended value per trade by the share price of the stock you are trading. Use this rapid calculation method to ensure consistent order size for all trades, allowing you to consciously grow your position sizes, since you account for your trade's dollar values for every time you press buy. Especially for afternoon trading, this handheld calculator order entry method lets you enter and exit positions quickly before a stock runs away from you. Note that many active trading platforms offer order review windows after you press buy. For afternoon trading, I highly recommend disabling this review screen, as it slows your trading down, often stopping you from getting the best possible fills in volatile situations. Start with one position at a time when trading. You can start to trade more stocks as your skills improve, especially if you have multiple monitors. Still, look for quality rather than quantity. It is better to start slow and make one great trade rather than making 3 poor trades before 10 o'clock. With one position, you can think about what went wrong in your position intraday and better your future trading with your self-reflection. Your active profits and losses are not your entire portfolio, but rather a certain percentage of your active trading fund that integrates with your overall long-term portfolio. Afternoon trading requires clear thinking and disciplined stop losses. You need to be emotionally unattached from your stock positions so you can holistically consider their performance both in and out of a trade without letting emotions cloud your vision. Do not try to catch a falling knife when you first start out. Accept any early morning losses and move on. If you lose any money on a stock, ignore it for the rest of the day. Conversely, stick with winners while simultaneously looking for new 9-to-noon opportunities. Set hard limits on how much you can lose in a day. Follow these limits. Give yourself time and find the patience to find the perfect setup rather than trading with no defined strategy for consistent profits. Minimize your market tuition and losses and keep studying patterns and psychological rules to better your trading. Anger and greed can drive your trading into a stress-filled, unprofitable state. Never get mad at the market or yourself. Try to clear your mind before you start screening in the morning. See Chapter 1 and 36. I meditate in the morning and at night after reading my long-term goals to clear my emotions and prepare myself to tackle the market. Additionally, electronic music helps me stay razor sharp while trading. Figure out what works for you and stick with it.